Howdy. Welcome, everybody. My name is Jerry Strautzer. I'm Associate Dean and Interim Head of the Adams Sin Class of 2000 Department of Finance. We're honored to welcome you today to the second annual symposium on inflation. Second thing, at A&M, the second thing is kind of a big deal. We always say the first time you do something, it's an event or an activity. The second time you do something, it becomes a tradition. So, BR, I think we're in this one for keeps, it seems like. Just have a great afternoon for you planned. If you think about what makes for an outstanding symposium, it's really going to be three things. Thing number one is an interesting, relevant topic. We certainly have that today. Two is an outstanding panel of experts. We certainly have that today, and B.R. Adams will be introducing them to you in just a minute. And the third thing is going to be an engaged audience, and I think we're going to have that as well. So really excited for the afternoon. If you're like me and you follow the markets, you may have noticed this week markets have been really, really good, gone up just about every day, hitting new highs, it seems like every hour. You can see today they're a little shaky, a little uncertain. I think the markets are kind of waiting to hear what these guys have to say about inflation before they react. Hopefully we can get those things in before the closing bell. Now it's my pleasure to introduce the person who really made this thing happen. And anytime you get a joint effort between two universities, and anytime you get a joint effort between two universities who are rivals and haven't played each other in football in 13 years, soon to be taken care of, it takes a special person to build that bridge. And that special person is B.R. Adams. So let me now introduce B.R., who's going to introduce the panel and give you a bit of the ground rules today. Thank you.
Well, it's good to be back here again. We did this last year in Austin, which was the first iteration of this. It was Paul Rogi's idea and Douglas to kind of come up with this. We thought the world was ending last year, and since then, as of before I came down here, the market was up 29.06%. So let's have some more world-ending events again this year. Certainly inflation has been on our mind the whole time. The world did not end, but real assets, hard assets are something all near and dear on our minds. So I want to introduce our speakers this year. We're going to lead off with Douglas Cliggott, who has had a long and very esteemed career on Wall Street, has been chief investment strategist at JP Morgan, Credit Suisse, amongst others, is going to be leading off today. He's certainly the adult in the room, the economist, has been around and really knows what he's doing. Second will be Brett Harris, who needs very little introduction here, A&M class of 80. Brett has run, I think, 6 investment firms now that are pretty large, including the 3 largest allocators in Austin. We're fond of saying around here that Texas is the 2nd largest economy in America, 8th largest economy in the world. I think we have more or less like $100 billion worth of alt assets that are allocated out of Austin now. And part of doing events like this at UT and A&M is part of building a financial ecosystem, if you will, in Texas. And what we'd like to do is foster a place where more of these can be managed at home, alpha created here. And love to hear Brett's comments on that. He's also been a real assets investor. He's probably heard every pitch known to mankind, real assets. He will have a really interesting perspective that he brings to this. Paul Rogi, who has really been the genesis of this, my good friend for many years. Paul really cut his spurs running international money for AIM Management in Houston. AIM was the top mutual fund complex in the world during the 90s. It sold out to Invesco. Paul ran the international division of that and is just a storied part of our financial community in Austin. And finally, Reed Ianson. Reed is the economist at Kepler in Houston. He is a hard assets guy, a commodities guy, and so to bring a more Houston/Texas perspective to this more than what we had last year. We're going to be moderated this year by Sarah Zuberi, from the Department of Economics, and Shane Johnson from the Department of Finance will be moderating. Our format will be each speaker will get up and speak for 20 to 25 minutes. We'll have 5 minutes questions directly to that presentation. Then finally, that'll go on for 2 hours. And finally, we're going to have a 30-minute panel discussion with questions from the audience to round us out. There are refreshments and water out this entrance here if anybody missed that on the way in. So with that, I'm going to go ahead and let Doug lead off here.
All right. So I guess from the title, you might be able to guess what my story is going to be about. I don't share the Federal Reserve's view that we're months or maybe quarters away from a 2% inflation rate. I think more likely measured in years if we think about permanently lower inflation. What I'd like to do in my time is three things. I want to take a look back at the three periods of high inflation in the 20th century and see what we can learn from those experiences to apply to our current situation. Then shift to where are we now? And I guess what I would think of is the 2020s inflation process, and then make a couple of guesses at what might lie ahead. So here's a chart of the CPI going back a little over 100 years. You can see three spikes. Let's see if I can make this work. Yeah. So the 10s, the 40s, and the 70s. The reason for focusing on these is that I believe we can actually pick something out of each of these experiences and place it in our current situation right now. And in studying these four periods, it seems that there's a real pattern to the inflation process. And it's somewhat artificial, but we've come up with four stages of an inflation process. First one is we need some kind of catalyst, some really powerful events that completely disrupt the status quo, typically not just in the economy, but in society at large. They tend to be profound. They tend to change our behavior, not just sort of change the prices of some things, but literally change our behavior. From an inflation standpoint, the most powerful aspect of these catalysts is they shift some very important prices in our lives. This violent shift in some relative prices, be it the price of oil, be it the price of labor, that creates conflicts, right? We are all settled in a pattern of this costs this much, this costs that much, this is how much we earn. And so I'd like you to think of relative prices as not just what, you pay for a burger or what you pay for bread or milk, not just what you earn, but think more broadly. Think of prices kind of everything that in a 2% inflation environment like we had prior to COVID, they were pretty much settled in. And you kind of knew what you were going to pay when you went to a store. You kind of knew what you were going to get paid if you were going to be a university professor. You kind of knew what you were going to get paid if you were a university student working, at a part-time job. All those things get jumbled up when you have an enormous event like we lived through under COVID. And so this sort of fight, if you will, to get back to how we were in our relative positions, that's what I think gives us the elevated general price level. And the elevated general price level, what we call inflation, gives us a change in economic policies. And as I flip through the history, you'll see how we've changed policy in America to try to address periods of inflation has varied over time. And I guess one point I'd like to leave you with here is usually that policy change, it doesn't fix inflation. It's more like it calls a timeout on inflation. It like breaks the fever, if you will. But then to really get back to relatively stable prices for a long period of time, we need structural changes in the economy. And that's, what the heck's a structural change? I'll hopefully leave you with a better idea of that after we go through each of the high inflation periods of the 20th century. So 1910s, what were the catalysts? Well, kind of similar to what we've just lived through. We had a high intensity war in Europe. We had a global pandemic. The war, the pandemic, it fractured existing trade patterns. It really, global supply chains were broken. And maybe more so than in this experience we've lived through, it changed immigration patterns. It stopped them. This together really constrained supply, like we've lived through. And this constrained supply got collided with surging demand funding the war. So this created conflict. And again, this is sort of a persistent reality after you get this mix-up like we had in the 1910s with the First World War and the pandemic. What you have is companies, if their inputs go up, they want to raise prices to get back to their profit margin. General price level goes up. Workers want to get higher wages. They want their purchasing power to go back to the way it was. And so I think William Nordhaus came up with, I think, a pretty interesting image of the inflation process. It's like being at a football game. Like, I guess A&M's going to play UT again at some point. When it's really exciting, it's going to be a close game, right? Everyone's going to believe that. Well, close game, what's going to happen? People in front are going to start standing up. People behind them want to keep the same view. They're going to start standing up. You're going to end with the whole stadium standing up. That's pretty much the way I think of as an inflation process. Some prices go up, other prices go up. And the problem is a lot of people in the stadium aren't my size, they're Reed's and Paul's size. So it's much tougher to get a good view. And that's why it takes so long to fix. Okay, what was the policy response? Very different from the one we're having right now. After the First World War, the federal budget was cut by 65%. 65% cut in federal spending. The Fed raised rates, but when you look at the reality, the Fed raising rates from 4 to 7% really didn't do much. It was slashing federal government spending. And so the unemployment rate went from 1.8 in 1918 to almost 12 in 2021. And I'll just quickly go back to this slide. We didn't just get inflation going to zero, we got a 15% deflation. All right, so now we're going to go fast. This resolution in the 1920s wasn't an accident. Something really amazing happened. We had the roaring 20s. We had massive productivity growth. And in sort of the jargon, we had very rapid growth in so-called total factor of productivity. And to me, that might be the most important statistic in the economy, and one that's really hard to project. But essentially what it does is it measures gains in output that don't require more labor or more capital. It's truly innovation. So what does strong growth and total factor productivity do? It creates a win-win economy, right? It allows us to have real wages grow and profit margins go back to where companies are happy with me. So it's TFP growth, total factor of productivity growth, that allowed everyone in the stadium to sit down. 40s, everyone knows about the war, massive shift in resources, same type of thing. Everyone started standing up, inflation went up. We paused inflation not by dramatically cutting the federal budget deficit, in the 40s, what we did is we instituted wage and price controls. The idea was stable prices, stable profit margins. Let's just get on with this thing. We can't purposefully slow the economy down in the middle of the war. And here you're able to put data in on what happened to inflation. It went from 5.4 in the 40s to 2.2 in the 50s. Labor productivity was 2.9. Again, a key for me in this scenario was how strong total factor productivity was. And so, like in the 1920s, in the 1950s, we got an environment of strong productivity growth. Again, a sort of a win-win economy that allowed us to move on with relatively stable inflation. 70s was a different catalyst. It wasn't a shooting war. Some would think of it as an economic war when the United States went off the gold standard. But from an economic standpoint, it had a very similar impact as a shooting war. It changed a lot of really important relative prices. If you were an oil producer in the Middle East, you were buying goods denominated in yen and Deutschmarks. Yen and Deutschmark went up dramatically versus the dollar. We went from 360 yen to the dollar in 1970 to about 180 yen to the dollar in the middle of the 70s. Same thing with the Deutschmark, 3.6 to 1.8. So, import prices went up, commodity prices went up. The other thing we had that I think is less appreciated in causing the 70s inflation, Clean Water, Clean Air Acts. What they did is they forced corporate America to do a massive amount of investment just to maintain the same level of output. So you needed all this CapEx, and you just didn't get anything new out of it. And so for me, this is in some ways a similar reality to what we're trying to do with the so-called green transition, right? We're trying to do things very differently using different inputs, which means a massive amount of investment without getting any more net output out of it. So you had the same setting up the conflicts, relative prices moved around. We had a very different policy response from either in the 40s with wage and price controls or a dramatic cut in federal spending after the First World War. This was really basically all on the Fed, right? So interest rates just went to crazy levels. I'm old enough to have lived through this, and I won't say I chuckle, but I do smile at my kids complaining about 7% mortgage rates now. Mortgage rates were 18% in 1980, 81. Think of trying to buy a house, right, with 18% money. What did, I think, play a role, in a very symbolic role, was the Reagan administration firing air traffic controllers, because that basically gave sort of the all clear signal and being very, very tough on wage increases. Contrast that to today, when the current administration rejected the acquisition of U.S. Steel by Nippon Steel because the United Steelworkers went down. Very, very different environment from a policy standpoint today. But again, the extraordinary high interest rates gave us essentially the same unemployment rate as we had after the 1910s, up to about 11% in 1982. Unfortunately for us, it took a long, long time to get inflation down, because I think of what happened to total factor productivity. It collapsed in the 80s. Why did it collapse? I don't know. I don't think anyone knows. But it collapsed. And so I think we think of Volcker as killing inflation, but the reality is inflation averaged 5% in the 80s. It didn't come down to below 3% on average until the 90s. And note how strong capital spending was, right? Tremendous capital spending growth in the 70s and 80s. But I think a lot of it was going just to give us cleaner air and cleaner water. So it isn't just investment we need. We need innovation. We need things to go on that give us this sharp increase in productivity. All right, lessons from the 20th century. Pausing inflation. Fiscal policy works quickly. Monetary policy works slowly. But the real fix for inflation isn't what the Fed does or what the federal budget is. We need productivity growth. We need lots of it so society is satisfied with what our wages are and firms are satisfied with what their profit margins are. We don't need to go through the catalysts. The catalyst for our current inflation, very similar to the 10s, but also I think echoes of the 70s. So we're going to need a lot of investment, but a lot of innovation. Have the same kinds of conflicts. Real wages, we want them up. Profit margins, we want to keep them up. What were the policy response? We let a bunch of oil out of the Strategic Petroleum Reserve. Federal Reserve's raising rates. But now oil prices aren't falling anymore. Fed funds rate is still below nominal GDP growth. So I would argue Fed funds rate isn't tight at all. And financial conditions are loose. Here's a chart. The red is energy prices. The blue is overall prices. They kind of move together. And now energy prices have stopped going down. Actually, oil prices are going up. Hence, I think what we see is this modest reacceleration of inflation. Here's WTI. Here's the red line, the Fed funds rate. Blue line is nominal growth. Every cycle since 1985, the Fed hasn't cut rates until the red line was below the blue line. We're not there yet. So I'd be stunned if the Fed ended up cutting rates. I think what they're doing is slow walking the hope of a Fed rate cut. Now I'm going to say something controversial. I don't think there's a single member of the FOMC that would like Donald Trump to be president next year. They like doing what they do, not have someone charismatic yelling at them, do what I want you to do. These are financial conditions. The Fed puts this together themselves. Typically, they're tightening when inflation comes down. They're pretty loose right now. So policy response incomplete, oil prices moving higher. Talk very briefly about what I think are the two structural issues we have that are a big problem. And I'll leave one as an open one. What on earth is going to happen in durable goods prices? So a paper here, I strongly recommend reading. These are the most important commodities in America right now, the most important industries. Notice what's at the top. What oil prices do, oil is ubiquitous in the US. If those prices rise, inflation is going to go up. This is a measure of housing inflation. See where we are now, see where we were when we had 2% inflation. It's not even close. Why? We didn't build houses. After the GFC, we just stopped building houses. This is a chart of median wages, the blue line, and services inflation, the red line. Fits pretty well. They're both running at about 5% now. And to me, there's a link between the housing inflation and wages. And that's this one. The blue line is employment of so-called foreign-born American workers. The red line is native-born American workers. There's 1 million fewer native-born American workers in the workplace now than there was in 2019. 3 million more immigrants. So these are the issues we've got to fix. And I've got to stop, so I'm going to find one more chart to stop with. This is the reason why inflation is so hard for monetary policy to solve. The blue line is sales at Lowe's, Home Depot, housing-related durable goods. Inflation influences that. The red line is sales at restaurants and bars. Interest rates have nothing to do with that until the unemployment rate goes up a lot. And so we're actually on a higher trajectory on services spending than we are on goods spending. And I think that, to me, is why inflation's a multi-year issue to deal with, not, by the fall it will be solved. So I'll stop there. And you're up, sir.
So it was a great lesson, I think, for all of us here as we journey to the different inflation episodes across time. I wanted to ask you, you talked about productivity growth and inflation, the role of those in past episodes of inflation.
Right.
Moving forward, work from home and remote work has created a lot of opportunities and potential for productivity growth. AI is something that is on the mind of everyone, in university settings, as well, so it has changed everything. And I think in the workplace as well. So going forward, don't you think, what is your view about productivity growth coming from some of these areas?
I think AI is going to be amazing. I think AI is most likely going to affect what I do, or especially what I used to do. I think it's going to be a very powerful tool to cut labor out of financial services. It's going to be a very powerful tool to cut labor out of being a lawyer. It's going to be a very powerful tool to cut labor out of intellectual work. I don't see how it's going to be a very powerful tool raising productivity, building houses. I don't think AI is going to be a very powerful tool increasing the population of the United States. And the reason I want to answer it with numbers, if you look at total factor productivity, it's frightening to me how it's basically, and this is sort of a real measure of innovation, right? It's great that we have Facebook. It's great that we have Google. It's great that these tech stocks have exploded. But if anything, I think a tool like Facebook hurts productivity, right? Instead of working, you're playing online. And so what I fear is we're going to have to see capital inputs grow dramatically. We're going to have to see somehow innovation in the things that we really need, right? And so how do we innovate in housing? How do we create more houses that people want to live in at a lower price point? AI is not going to give us more land, right? It's not going to suddenly make home builders cheaper. So I have total respect, but the reason I actually wanted to put this up, we had a massive technology innovation in the 90s. The best it could do was get total factor productivity to come up to almost 1%. We had a really good productivity decade in the 2000s, but it actually didn't even get to what we did in the 50s and 60s. So, I have 3 kids. I want a ton of productivity growth. I want you guys to live in a low inflation fast-growing economy. I just have a really hard time seeing how we're going to get there from here.
Right stuff. Yeah. So, I think.
I'll just hop in with a quick question. So you mentioned the Clean Air and Clean Water Acts and how this was just this spending that didn't increase productivity. And then you mentioned the transition to green energy. And so green energy in principle should be cheaper after the transition. And that would lower production costs for firms. So do you think there's any realistic chance that transition ultimately sort of more than offsets this sort of replacement of capital effect that you're talking about as opposed to new capital that's productive?
I do think there's a chance, but over what time horizon? Because the reality is what we need now is we need lots of investment in fossil fuels besides lots of investment in wind and sun, and I think also small modular reactors. I mean, sometimes the wind doesn't blow when it's dark, right? And so, yes, batteries are going to be really helpful, and we can do things moving water around. I get that. But I think, yeah, if we look out over the next 6-7 years, we need to do a massive amount of investment of, I guess if you want to call it old energy and new energy. And so I don't see how that doesn't increase the price point of essentially everything we're using. All right? Thanks. Thank you.
Wow. Stretch my legs. All right, so let's just transition here in terms of productivity. Let's just do a simple thing. The rate of growth of the economy is just the inflation rate plus the growth in workers plus the productivity, how much they can produce. Our real growth since 1980 has been, during the expansions, has been falling 80 basis points every time we've had an expansion. Japan's rates, Japan's level is 1.5. You saw 2.1 up there. Any mathematicians in here? One more 80 basis point drop, and we're at Japan levels. That is why you got such a big response when COVID came. We could not take another hit that low. So I'm going to talk about the backdrop, and then we have I'm going to reinforce some of the things that you said. Because we are in a new era from, I was in these seats in 1980. That era ended, you never know exactly, but around 2020. That was also around the same time, just as an aside, that China's second phase of their 3-phase plan also ended. So they're now in the third phase, which is, adversarial as opposed to collaborative. And we've been in this era of deflationary. So when I came out, the discount rate was 20%. It's been zero quite a bit here lately. I don't know how complicated it has to be. 20 to 0 is not going lower. You can say you can do things to make it appear it's slower, but we said we're not going to do those things. So you can rule out lower. So for this entire time frame, we've had the Federal Reserve at our back. Every time we've had a problem, it was, as long as it was deflationary, the Federal Reserve, whose main tool is dropping interest rates, had plenty of ammo. So discount rates was at 10, 20, now it's at 0. The inflation rate was 13 or 14. It got into, now it's been under 2 for quite a long time. Until very recently, when it popped up to what? 9%. And so all of a sudden, what's your mortgage? How many people could afford a mortgage at 3% that can't afford a mortgage at 7%? These things matter. So let's look at some slides. By the way, I'm from a company now called Eagle's Wings. It's CEO concierge service, and also menu manager. Fortunately, my assistant is making this come up. I thought, why aren't these titles? He's making it come up. Okay. All right. So here, first of all, whatever inflation is, inflation is a wealth killer. That's one of the reasons we try to keep inflation low. We try to keep inflation around 2% because that's about the same rate of growth that you had in gold. But the stock market is inflation's kryptonite. $1,000 in cash put under the mattress in 1945 would be $1,000 today, and a 90% drop in buying power. $1,000 invested in the U.S. stock market in 1945 with dividends reinvestment would be worth $3.5 million today, which is a number that is beating inflation as measured by CPA by roughly 2,000%. We do not want high inflation, but if you get high inflation, you have to shift the strategy, and some of the ways that you shift it are counter to it. Here's inflation over 20-year periods, and the thing I want you to get out of this, you're not going to be able to get out, so I'm just going to tell you, we don't have much data. This is 20-year periods. How long do you think the world's been around? I don't care. It's been around a long time. This is all from this point forward is about all the real accurate data that we have. And so you see here, as you get into the 80s, you're going up. This is one of the eras you're talking about. It bottoms out here, it goes up there. And as this escalates, first of all, our rate of growth of our working population was 2%. Now it was at 20 basis points, something like that. So you understand what that means, right? You take 1.8% off the top right away. You don't have to have a huge math degree to figure this out. So we have to make up for that with productivity. And our productivity stinks. Our productivity has been flat or down for years. How can that be? You have all this technological crap, that's you're used to substitute for your brain. How can it be with all this great technological stuff that our productivity is going down? I've been an advisor. This is really scary. I've been an advisor to the New York Stock Exchange and the Dallas. I haven't Stock Exchange, but I'm talking about the New York Federal Reserve. And so they were trying to figure out, where is the productivity? What is the problem? They found one sector that had amazing productivity. Anyone want to guess? I'm not moving forward until I have a guess, so you can stand here all day. IT. No. Oil and gas. Well, oil and gas was actually super efficient. So that's not the answer, but I'm going to stop there for a second. In 2009, in 1980, the S&P was at 109. Oil was at 35. The S&P is at 109. Oil is at 35. What's the S&P today? Roughly, you guys should ask for a refund. It's like 5,500. 109 to 5,500. Oil price was 35. What is it now? That seems like a lot less. As a matter of fact, it's been 35 in the last 5 years. No price appreciation whatsoever. But a technological miracle for our country occurred. What was it? Anybody know? What was our big problem in 1980? We were dependent on the Saudis for energy. We were not independent. We could not produce enough energy ourselves, and so we were dependent on other people. Do you realize what that means? It means they stop. You get in a war, they stop giving you the energy you need, and you don't have anything to fight with. They say they stop giving you the energy you need. You can't drive. Trucks can't move. It's a terrible situation. And today we're energy independent. Jerry, would you have ever thought in 1980, if you would ask for a bet, like, we're going to be energy independent someday, who would have taken that bet? Nobody except for Jerry. He would have known. And yet here we are, energy independent. Technological miracle. With no price appreciation, these guys made us energy independent. And of course, now they're being the pariah. They saved your rear to everybody. And they don't like being treated like they did something wrong. Now, we can talk about that if you want to. I am also the chairman of the San Jacinto Project, which is probably the most effective climate change group in Texas. So far I've said nothing that I plan to say. Here are the same cycles that which you saw earlier. Here's the depressionary period. Here's the war period. Here's the really 60 to 80, and you see here this green line is the government bond yield, and then you see it just it's way up there. Actually, anyway, it's really high, so that's up there. If that's the government bond yield, that's probably 15% or so. I sold AAA bonds for Earl 9 at Texas Utilities for 17.5%. And he said to me, "You're amazing." And they also had a 5-year call. And so you've got this period right here where inflation is escalating. And look at this. Is that straight up? So at this point in time, inflation was getting out of control. It's like a train going up this mountain, and the train track ends, and if you don't get the train turned around, it's going to go over the cliff, and everybody's going to die. So when you see that happening, you'll see people getting out of paper assets, and so your gold price. I remember my dad was not an investor at all. Wonderful guy, super smart, wasn't an investor. With 1980, I remember going around buying gold because everybody had to have gold. Because everybody's getting off the train. Because they were afraid that the economy is going to go over the cliff. But it did. Always remember that no matter how bad things are, somebody is working to make it better. It's not like we just sit there and say, well, just let it happen. There are powerful forces that are reversing this situation. And so there at the peak, around 1980, Paul Volcker comes on the scene and basically takes a knife to the throat of inflation, puts the country into a recession. I remember, you guys tried to, that was my first year at work. I got a 10% raise. Now I realize I was terrible because inflation was 15%. I had no idea. You're totally oblivious. There's a time in your life when you're so oblivious. It's a wonderful time. And then later on you know something, and it's some more realistic. But anyway, so how many of you are skiers? What does this look like? That's the best ski run ever. You stop the ski, you're at a 14,000 foot ski slope. And you're going to run that baby all the way down to zero. You got some, moguls in there. What happens when the interest rate, when inflation is going down, what happens when inflation goes from 14 to 13, 13 to 12? What does that affect? It's called a discount rate, people. And you're able to lower the discount rate. You actually have to lower the discount rate. So as interest rates go down, your discount rates goes down and down and down. And about, that 109 to 5,500, about 60% of that gain is from simple multiple expansions because of the because of the reduction in interest rates. And that's, people, what you're normally focused on is things like in the little squiggles around things. That's the normal business cycle, and that's what, this kind of thing happens once in your lifetime, maybe twice, once that you're going to be aware of. And everybody is so anchored into this period that it's hard to adjust. So you see here, when I put this up in September 2020, I was talking to him about we're going to have looks like we're going to have the end of an era. And so you see, it says, now what? It's not enough to know this is going to stop. You got to know what's going to happen next. And that's hard. And so these are the scenarios that we put up. The most likely scenario at the time was your Japanification, because that's where we're headed. But since that is the most likely scenario, what's going to happen is all of the effort is going to make sure that that scenario does not happen. So then it becomes the least likely scenario, except for a repeat of what we just saw. You can't go from 20 to 0 and 0 to minus 20. If it's super complicated, everybody, if it's super complicated, hard to understand, forget about it. It's obvious. It's simple. Now, if you're trading derivatives and you're trying to get 3 basis points, it's hard. So that leaves the other two. So we head up to that period I just showed you. You are kidding. That's free. Okay. Okay. So I was going to show you the entire new form of economics. So this is the period that we saw. And so high inflation above average growth, CPI around 5, GDP 3.8, real returns on the S&P minus 2.2 because severe multiple contraction. But you know what happens in this scenario? You also pay off your debts. The other one was this period right here, which is a war. And it turns out that for the time being, we have both of these. And so this is a really professional looking chart. I can't get rid of this one. Stupid looking chart. But you see the ski racer down here. But I'm putting this up here because here's what happened. This is after we said we don't know what's going to happen. The fastest increase in rates ever. The Fed is going to try to maintain 500 basis points of ammo at all times. So when people are saying, I don't know how far they're going to go, they're going to go to 500 basis points as they possibly can. So you see it right here. This is when, things are good. Then if you have 500 basis points, you have 25 basis points for every 100 basis points. 4 of them. That's like guns in your gun belt. You want as many bullets as possible. One bullet is not going to kill. A recession coming on. You need like 20 or 30 of them. And so they're restocking here. And then all of a sudden we had GFC, and we went into this period of no growth. Of low inflation. I could say a whole bunch about that. You see right here, they started again. They couldn't do it because they ran into problems, and then they finally have been able to do it. So that is the end of my speech. Because of B.R. Adams, I want you to nail it, put it on him. Yes, sir. Okay. Thank you very much.
So you said one thing where you said someone is always working to solve.
Yes.
So with the debt to GDP ratio that you showed us, what do you think is going to happen there? Because, there's no, I don't know, like tax debts.
That's
tax.
GDP. You haven't given enough information.
Okay. I mean,
I don't have enough information. That's not, I want to know the debt service.
So,
What's
interest.
the debt service?
So interest rates you think are coming down. So right now interest payments are the biggest
I'm
components.
I'm pressing you because it's an important point I'm trying to make here. It's the debt service that matters. And debt service as a percent of GDP in 1980 was 4%. And debt service relative to GDP last year was 4%. Now it's a more dangerous 4% because if we ever slow down, there's a bigger amount of debt out there. But our ability to, can you service your debt is the question. It's like, you're not stupid, you're brilliant. But just because somebody has more debt, well, I got more money, so I have more debt. So debt service, and so I have not worried about the debt at all until now. Because in the last 12 months, as a percent of GDP, it's shot up. So as far as so imagine, we have our growth, we have debt going up, but we also have growth, just covering that debt. And we have interest rates coming down, so the debt that we're putting on has a lower and lower interest rate. And those two things offset and have the same. And so we're by far the strongest country in the world with all of our problems. But the danger is that we start to slow down. And then to your point, rates start to rise. And instead of going like this, all of a sudden you start to slow down, your interest rates start to rise, and the world is watching, and that gap between your growth and your ability to pay your debts gets smaller and smaller. And nobody waits for the thing to be completely across. As soon as the world gets a hint that that's where we're going, we will struggle to keep the U.S. dollar as a global reserve currency. It's a very good question.
Well, thank you very much for coming. My name is Paul Rogge. I think I have a different kind of perspective, which I hope you'll find valuable. I actually grew up in Lincoln, Nebraska. Spent a lot of time growing up on a farm. My dad was a cattle feeder in a small oil company. So I grew up in the 1970s paying attention to commodities a lot. Came here to University of Texas, not here, there, to Texas. Did my undergraduate in business school, and then I had a foot really in both schools of thought, the business school and the economics department. My honors tutor at the University of Texas was Walt Rostow, and he did a lot of research on raw material versus finished goods pricing. And so what you hear about when you hear people discussing inflation, what is the general level of CPI? What's the general level of inflation? Well, I started my look at that not in the general level, but how are raw materials and commodities doing relative to finished goods? So looking at inter-economy inflation, where the margin was going. And I think that really set me apart as an investor. I got hired, my first job was with UBS in London after graduating, and then I got hired into AIM funds to start up the international group. International department, we had 30 different countries were invested in eventually. I started with $10 million and then retired after the department was $16 billion. Greg Dynick, my business partner, and I then started a hedge fund, Rogge Capital Management, in 2000. Once again, doing international long-short, looking for the short side as well as the long side in investing. But throughout this whole time period, the real governing principle of my investment career was looking at that relative price movement between raw materials and finished goods. So let me make sure, is it the red button that gets you there or no? Okay. Today I want to talk about first what I perceive as structural problems with inflation, why this is a much longer term problem than what I think most investors are thinking. Second, look at the investment implications of inflation. So as we start to see prices rise, inflation move forward, how does that affect how we construct portfolios? And third, I've developed, and the guys at Real Asset News have developed useful tools, I think, for this new environment. Because as we're looking more at commodities, we need new alternatives just to the old CRB, for example. So this, I think, is the most important chart. And this is kind of an aha moment for me. And we've covered a lot of history, and so I won't talk about this as much. But let me explain the kind of model of how I think about inflation, the economy, and investing. You know, my first paper that I had to write for this economics tutorial I took was about the cotton industry in the U.S. in the 1830s. That sounds kind of obscure, but it's a perfect economic model in that it's an introduction of technology. It's where the U.S. first started to use the Industrial Revolution, entered the Industrial Revolution. So in the 1920s and 30s, you had canals being constructed. You had machinery being brought in to mass produce cotton textiles. And that was a lot more efficient than just one guy on a loom. All of a sudden, you could put that in a factory. You could produce a lot more textiles and a lot more cotton cloth at a much cheaper price. Think about it. That was very similar to what we've seen, I think, over the last 30 years, where we could move production of goods into China and a lot more produced at a cheaper price. Also, with the introduction of technology in the U.S. economy as well as the developed economy, more was produced at a cheaper price. And so if you pull forward in that in the 1830s, it was a great time. All of a sudden, you were starting to develop new consumers that could buy more cloth too. So you had a reduction in that finished goods price, and you had an increase in consumer spending, which all pulled through a lot more demand for cotton. And what was the big beneficiary eventually? It was actually cotton growers. It was the commodity itself, because that supply chain then gets taken up as productivity has increased. And that's really, I think, the story when I think about inflation. What are the great times of inflation? And that's kind of economists describe this as the production function of an economy. How does an economy function to produce things? Well, the production function of an economy is changed through technology, through, in the 1920s, assembly lines. 1950s into the next inflation, it was the growth of the consumer economy. And remember, we rebuilt Europe after World War II. So we brought on a huge amount of productive capacity to produce more consumer goods. People came out of the war, and we created consumers around the globe, which set the stage for the baby boom inflation of the 1970s. To explain this chart a little bit more, this is the value of real assets versus financial assets. So when the line is dropping, that is the value of commodities, it's the value of commodity companies, it's the value of REITs versus financial assets, which was I believe, a 60-40 bond equity portfolio during that time. So when it falls, real assets are losing. When it rises, real assets are gaining. And you see during these time periods of sustained inflation, when you have commodity inflation, of course, then real assets are outperforming financial assets in that time. We've gone through a time period over the last 40 years, where, as Britt pointed out, I mean, we went from that's down the big ski run right there, from high interest rates to very low interest rates. And that really caused financial assets to do quite well in an environment like that. Now I think we're very much set to reverse that, as we have what I think is a really big story, the global consumer boom. Throughout my career, too, I've really followed the global consumer. It's one of the things because of my background with economics at the University of Texas, and saw what the power of a new consuming economy could do. Our hedge fund was one of the first to really get behind a lot of the domestic consumer plays in China. We're one of the first investors in Li Ning, a shoe company in China. Well, I think you kind of haven't seen nothing yet. We're talking about a boom, and this is global consumer spending, roughly 40 trillion. If you back this up to 2010, it's just below 40 trillion. And you have this growth, some growth in global consumer spending. That dip you have then in 2020 is the pandemic. And then all of a sudden, global spending is off to the races. And that comes from the growth of the global middle class. So that's the worker in China, that's the worker in India, that's the worker in Indonesia or wherever, all of a sudden getting paid for their work. And when they start to make more than $5,000 per household per year, you have a lot more available for disposable income. That's when you start buying maybe your first moped. Or if you have a moped, you go up to a car, you get an air conditioner, you get a refrigerator, you buy an extra 6-pack, or you buy another chicken in that week, so you have protein consumption increases. So that kind of growth of the consumer, I think, will show up in commodity markets. And we're talking about then pretty much the global consumer spending going up by a little over 20 trillion over the next 6 years. That's what I think is going to drive inflation going forward. And it is a global phenomenon. This is looking at a few countries, US, China, Europe, Japan, and their inflation rates. You can see how, once again, that kind of slide that Britt was illustrating, inflation was not a worry until it became a big worry. And I think it's a global big problem. Now, the one thing I will say that I put out there that I worry about is, well, what if China actually slows too much? We've got a real debt problem there. We've got a real housing problem there. Yes, in the short term, I think that could derail the consumer spending model, but also you got to remember this is kind of consistent with the normal development of a developing economy. If you look back in history, a lot of countries, even our own U.S. economy, when it was developing, developed a great export sector first, grew through exports, grew its workforce, grew its middle class, and then eventually that domestic consumption becomes the main stage for growth of the economy, not the export economy. And this is consistent, I think, as China, quote, slows down. They're slowing down now from a much higher level, and they're transforming their economy from, I think, a export economy to looking at the average everyday person. If you listen to what Xi is talking about, he is concerned about the average everyday guy in China, not so much the tech billionaires anymore. So that, yes, is a worry for me, but I think it's consistent with what's normal. So then when you get across the three commodities, and Ryan will be talking about oil, so I won't really talk about oil or energy that much, but it isn't just oil and energy. It's mining and minerals. For example, if we do go through a green transition and we try and grow the use of electricity, what do we need? We need copper for that. Well, the average ore content of copper has halved in the past 20 years. So that means you have to crush twice as much rock just to get the same amount of copper. And if we want to meet our targets for emissions, in the US, we actually need 3 times more copper than what we consume now. So there's a huge demand that needs to be filled up. And we haven't had a new copper find really globally in the last 10 years. So I think that's setting up a great investment case for industrial metals like copper. We'll need 10 times more nickel in the economy if we want to hit those targets for emissions. So if you're in business here in business school, head to a mining firm maybe. I think it's pretty good. And then this hits dear to my heart. This is agriculture. And this is looking at, as per capita GDP increases, how much meat and what protein consumption is there? And this, I think, is one of the more interesting investment cases looking forward is agriculture. Full disclosure, my family's been involved. I'm a 6th-generation farmer. We're very active in farming in Nebraska right now. And people don't think about that. They think of it as, farm to table, how local farming is. Well, that actually was one of the biggest beneficiaries of globalization. The ability of the food and the grain that we produce out of Brazil comes about because, well, Brazil does not have any fertilizer, desperately needs fertilizer. It depends on the third of the fertilizer globally that is manufactured and created in Russia and Belarus. Politically, that's rather tenuous now. And where does that fertilizer go? Also, as China tries to increase its production, they need that fertilizer. So you see this huge kind of movement or ability to maybe move that fertilizer out of Brazil into China for political reasons, for other reasons. And that would put Brazil in a very bad position. The soil in Brazil, for example, if you cut down the Amazon, it's much more sandy soil. You have to use a lot more fertilizer to get your production. Here in the U.S., our corn belt was grassland. We've had thousands of years to establish feet of topsoil. So we aren't as dependent nearly and that fertilizer. So in that sense, Brazilian agriculture is dependent on globalization, the movement of fertilizer and seed, by the way, to Brazil. It's also dependent on imported farm equipment coming from the U.S. We are so blessed here in the U.S. to have fertilizer produced here, equipment produced here. We have our own topsoil here. We have irrigation here. And I think that's where I'm very, very bullish on U.S. agriculture versus globally. The production increases we've seen. Now, essentially what this is showing that as we grow per capita GDP outside the U.S., the amount of protein and the amount of protein that's demanded as those people enter the consumer force globally goes up almost logarithmically. And for example, in chicken, it takes 4 grams of grain to make 1 gram of chicken. It takes 8 grams of grain to make 1 gram of pork. It takes 12 grams of grain to make 1 gram of beef. So there's a huge logarithmic demand on grains going forward if you want to produce more meat. So kind of to conclude with what are some of the structural issues I see, A, they're international in nature. B, it's commodities. And if you look at any sustained period of inflation, that is when you had a sustained raw material rally. And we're facing supply issues with many of the commodities. As Doug pointed out, we have pressures with wages and labor. The irony is, like number 4, demographics, we thought were going to be deflationary as more people retired. But as Doug pointed out, when people are retiring, we have fewer people in the workforce, so the cost of labor goes up. What we thought would be deflationary is now inflationary. And then finally, as we're talking about globalization, if we are looking at a deglobalization now, if we're looking at a new Cold War, which frankly I kind of think of, where we are now with China and Russia, is bordering on that. Henry Kissinger, before he died, had a great quote that somebody asked him, are we in a new Cold War? And he goes, well, we're not in the new Cold War yet, but we're in the foothills. I would tend to agree with that. We're in the foothills, and that could have huge impacts on global supply chains. Anybody who has an iPhone in front of you, that iPhone has 1,100 different supply chains around the globe. It touches 50 different countries. So heavily dependent on that ability of globalization. If we lose those links, the cost of that iPhone could go up quite a bit. So now as people talk about inflation too, I kind of want to switch gears a little bit. This is CPI. I know there's other things to look at. But the thing I would point out, especially growing up in the 1970s, inflation, this is year-over-year inflation, comes in waves. You have these moves up, and then it would come back down, and everybody would think, oh, hey, we beat it. And what's driving that, to me, is inflation is not just a monolithic thing that rises all boats. It first ripples through the oil market, then the grain market, then the labor market. And then if the labor wages rise, then end demand is there, and so then pops up in steel, and then back to oil. And so that kind of rolling nature creates that volatility or movement of inflation. So it's really quite normal right now to have seen inflation come back and also have the opinion probably not beat either, because at least in the 1970s, the last time we faced real supply issues, it tended to rise and fall only to rise again to a higher level. That's one thing I like to point out. As far as implications, let me see. This is a risk premium. This is actually the first model I ever did. This was 1990 when I worked for UBS in London. I was real technologically advanced and launched a equity risk premium for them. And that's measuring what kind of premium you need to give equities over bonds. I was just looking at that old note the other day and saw how that risk premium rose during the 1970s and stayed at kind of a new plane. And that's the effect of inflation, where all of a sudden equities relative to bonds have to have a higher discount. And also future earnings are discounted at a higher rate, so therefore they're valued lower. And it created a rotation in the market. So I use the term long duration equities versus short duration equities. Long duration equities are technology companies that are maybe working under a loss this year, next year, but then we think we might have a profit 5 years from now. As opposed to an E&P company, which is how much oil did I produce this year? then what were my earnings this year? That's a very short duration equity. So as the risk premium goes up, I really don't like to be so negative on equities as I am thinking this presents a great opportunity for rotation and valuing companies like BHP or Rio Tinto or some of the global mining companies or large oil companies too, a lot higher because they're selling at 3, 4, 5, 6 times peak earnings right now. That's a dirt cheap price, in my opinion, versus some of the tech names that are longer duration equities. If we move back to a time period where investors are expecting more inflation, I think the value of those near-term earnings will be valued higher. If you look at what happened in the 1970s, this is the value of equities, doing not much for a decade. But commodities, oh my gosh, that's the Goldman Sachs Commodity Index, up almost 7 times. So that's where my family, that's in Nebraska, that's what made Texas too. We're in the 1970s. When you talk about how to invest in commodities, well, as Britt pointed out too, the real value of oil hasn't moved that much. And this is now a real return versus the real return of oil companies. As that technology flows through, as that ability to create value in that industry comes through, they've been a great investment, especially magnified investment over just the commodity. That's if you look back in the 1970s, then the top performing sector was the oil sector in the S&P. And then if you start looking at correlations, I got this from Vanguard. The whole industry has been built on this idea of a 60-40 portfolio. That when equities do well, bonds maybe do or not, but eventually when you hit a recession, equities would go down because earnings went down, but at that time then bonds would go up. So you got that diversification benefit for a negative correlation. Problem is this is the 2000s right here. When we have inflation above 3%, that's when that correlation tends to be positive. If we're talking about an era of above 3% inflation, that means that bonds and equities will be positively correlated, not negatively correlated. So that's a huge change for the pension industry. The only way I think they reach that correlation or lack of correlation, diversification benefit, is to then turn to real asset investing here. Farms, oil companies, mining stocks. Those are the things that retain their negative correlation to inflation, or positive correlation to inflation, negative to the rest of the market. A few other quick points. This is the CRB index, and when we get into how do you look at investing, well, the CRB index is probably the most quoted index for commodities. You can see that peak of the last, what they call the global super cycle in commodities here. This is very heavily weighted in oil. It has kind of oddball commodities, in my opinion, like cocoa, coffee, don't really flow through the economy so much it affects your cup of coffee from Starbucks. So my brother actually, and the guys at Real Asset News, developed a new commodity index that they look at. It's an even-weighted commodity index. Here he threw out the cocoa, the less important futures contracts, pulled in a few things like iron ore that is not in the CRB index, and made it an arithmetic average. So as you have a limited number of commodities, when one would rally quite a bit, it would all of a sudden change the makeup of the index and become unduly important. Here is an arithmetic average, very much like the value line index. It's an even weighted thing. And this, I think you can see intuitively, this makes more sense as you approach inflation. This was what my experience is, that biggest rise we saw was a time after the global, I don't want to say plague, COVID, that kind of rise there. And the idea that seems to make intuitive sense to me. Then if you look at real asset equities, so that's looking at an index of oil and mining stocks versus the S&P, you see this huge decline from the top then with the global financial crisis and the rise of technology and the rise of the rest of the S&P. But once again, pointing out the bottom there in COVID, we've seen real assets start to outperform even in the great equity market we've seen. So they're cheap. You're starting to see relative outperformance. And I think the fundamental case for them running over the long term is definitely there. And that is actually where the index is now, not relative to the S&P, but the absolute level of the index. See, as we've come up for the past few years, we've had that kind of flat top. If you're a technician in the crowd, you kind of like how buyers are able to buy that and willing to buy that at higher lows. And I think that's shaping up to be a good trade. So with that, any questions?
Thank you for that very different, slant on things. So the quick question is, unless I misunderstood things, it seems like there are times when the commodity outperforms the producers.
Yes.
And then there are times when the reverse is true.
Well, when commodities outperform the general economy, but during a commodity boom, I would rather own the commodity producers. So equity of
and that was
oil
my
companies.
question. Yeah.
Yep.
Okay. So, but what's driving that difference? Like you mentioned with oil and gas, the technology that permitted oil and gas companies to have greater profits while oil was relatively flat in price.
In real terms, that's productivity. That's why you want to own equity in a stock. So for me, yes, I like the commodities, but I love the equity in commodity producers. Does that make sense?
Yeah, but do you have a way to predict which outperforms?
So I would take usually the equity side over the commodity. What's that?
Thank you.
No. Anything else? Yes.
About a bunch of supplier related issues,
Yep.
beyond the Fed. So we've seen easing of some of those supply chain pressures that could cause inflation to go up to 9%, right? Like on the goods side. Consumption has also moved a lot. There is now much more consumption of services as well. The composition basket of the consumers changed over the COVID period too. So on the services side, what kind of supply constraints would you,
Or what am I worried about going forward?
Yeah.
Once again, everything with globalization became so tightly linked across so many countries. And now politically and economically, we have a big division coming up between us and China, us and Asia. And I think the one thing that COVID taught us was it's more important to put the emphasis on just in case inventory instead of just in time. So frankly, where I see great opportunity is moving manufacturing jobs back here to the US, taking control of those supply chains within at least NAFTA's border. That's a wonderful thing about Mexico. The Mexican market, I think, looks fantastic as a beneficiary of this re-onshoring. They may not re-onshore it to the US, but I think they might re-onshore it to Mexico. And so you'll see that NAFTA area, I think, become a much more integrated economic force, which is, and I think as you look around the globe, really could be in a great position going forward. American agriculture, American oil and gas, American fertilizer, and then the growth of manufacturing. So
basically, you think this defragmentation or, we are at the end of globalization, this Cold War is going to go on for a while, because these things that, there have been efforts now to have chip companies within the US borders. These things will take a very long time for those types of investments.
It will take 10 years, 10 plus years to get semis actually produced in quantity here. So yes, that's an issue. But you're looking at somebody. I've built my whole career on globalization. I'm not. It's not a political person in this hunt. I'm just looking at where we are and what's important for our economy, and thinking we're probably wanting to create those manufacturing jobs here and keep more control of our supply chains here than global. So it is a different era, I think, to echo Brett. Well, thank you very much. Okay.
All right, so I get to close out this set of awesome presentations. My name is Reed. I work at a firm called Kepler. For those of you who haven't heard about Kepler, we track global seaborne trade flows in real time, right? Mostly commodities focused. And then we deliver that data to clients. I also sit on a research team of about 30 people for folks who may not want our data, but are looking for a view based on our data. My job at Kepler is basically looking at the macroeconomy to give outlooks around economic growth, which ultimately flow through to our supply and demand models across our different commodity verticals that, again, we then provide to clients. Today, I'm going to focus in on the petroleum markets and be a little bit shorter term focused, really kind of giving some price outlooks and some thoughts around where there could be some inflationary pressure, specifically in oil and petroleum markets over the next 6 to 12 months. So again, some trade ideas, if you maybe want to get into futures markets, are going to be coming up. So first, let's go ahead and just start with setting a baseline for our expectations for oil markets over the next few months. If you look at the chart on the left, this is our expectation for spot Brent prices. That's your global benchmark for oil prices. We see prices trending higher over the next few months. And if you look at the orange bars, that's your year-over-year delta, right? So again, we expect that oil will be a pretty inflationary factor, especially through the summer months. Oil prices start to rise from here. The reason we believe this to be true, if you look at this chart on the right, this is basically just your global oil supply demand balance. When the bar is negative, that means that demand is outpacing supply. When the bars are positive, that means supply is outpacing demand. You'll notice that mostly in the post-COVID period, we have been undersupplied, just given the large decline in productions we saw through 2020, and then the rapid pickup in consumption we've seen over the last few years. However, if you look at 2024 in particular, we were pretty oversupplied coming into this year. And that's been a critical factor for why oil prices have kind of, traded flat a bit, maybe not been super interesting, especially since, say, August or September of last year, we really saw oil prices come off the highs, at near 100 per barrel. But we do think that prices are going to trend higher again. As you can see, we do think that fundamentals are going to tighten up. This is a normal summer occurrence in terms of oil balances, flipping negative. But again, we see prices trending higher just because the baseline relative to last year is a little bit higher. Okay, so kind of what are the inputs to this? I'm going to tell you right now, price is really being driven by supply, which I'll touch upon in a moment, but you do need to we do need to quickly just discuss where demand is within the oil market. But I'm going to tell you right now, it's really supply is driving sentiment and is driving price right now. However, on the demand side, if you look at this chart on the left, this is just total crude refinery runs, right? We're at about 83 million barrels per day this year. That's going to be growth of about 1 million barrels per day year over year. That's the bottom panel on this left chart. And again, just looking at this in terms of core clean product demand, which is jet, diesel, and gasoline. Those are your three big core outputs that you get from a barrel of oil. And you'll notice growth this year, again, at about 1 million barrels per day, definitely declining off the massive increases we saw following that decline in 2020. Interestingly enough, most of the demand growth this year, about half of it will be driven by jet. Jet is really that one area of the market where people are pretty excited. I'm not going to talk a lot more about jet today because it's a pretty niche market. But it is important to note that like airfare or air travel is a really exciting area for a lot of folks in the oil market right now. Like I said, though, right now what's driving prices is supply. That's really important, specifically watching OPEC. So if there are two things you need to watch out for to try and get an idea of what oil prices are going to do when you're following the news flow, pay attention to Saudi, pay attention to Russia. Your two big players right now. Saudi Arabia, on the one hand, is really trying to implement very heavy amounts of production cuts to support that oil supply-demand balance and keep it pretty negative, especially through the summer. They want to see a Brent price of at least 80 per barrel, right? And this is why you're seeing them really step in. Like, look, early last year, they're producing over 11 million barrels per day, right? This year, they're going to stick around 9.5. That is a significant cut, right? And they're going to maintain these cuts through the rest of this year. Anytime you see news that they may not be complying with their production cuts, you can expect oil prices to sell off. And again, across OPEC Plus, more generally, anytime that there's conversations about how they're not complying with production cut levels, that's going to be bearish for prices. The other player to watch is Russia. Obviously, it's been very interesting. Post-Ukraine, there was a lot of negativity around where Russian oil production will go. Reality is, it's continued to kind of climb higher, especially last year. We do see production in Russia down a little bit this year, mostly driven by self-imposed production cuts over the next few months before output climbs higher again. I'm going to touch a little bit more on the issues with Ukraine and Russia. Ukraine right now is very aggressively targeting domestic refinery infrastructure in Russia, and that could have some interesting implications. But our expectation is for now, those attacks are not going to have a notable long-term or even medium-term impact on Russian oil production. All right, so now I want to kind of focus in on gas, oil, and diesel markets. I'll shift to gasoline in a minute. And I'm going to really focus on two areas where you could see some inflationary pressure, especially through the summer and over the next several months. When it comes to diesel markets, it's going to be all about Europe. So I'll come back to that in a minute. But let's go ahead and level set and just take a look at the diesel demand balance for this year. We think it's going to narrow a little bit, but again, we have just under 300 KBD in net supply to the gas oil market this year, so it's not like we're in an undersupplied market. The narrowing in the balance is mostly being driven by a bit faster demand growth relative to supply. So again, this left chart is just your year-over-year growth in supply versus demand, right? And so that's what's causing that bit of a narrowing in the balance. But we've seen this general balance over the last couple of years. All right, some more comments on Russia and kind of back to the story of Ukraine and the issues going on there. Ukraine has attacked several critical refineries in Russia. That does impact quite a bit of diesel production. However, the reality is that Russia has a lot of spare capacity at other refinery facilities. So technically, they could just ramp production at these other refineries that haven't been hit. If the Ukrainian attacks continue to be successful, this story could change. So it is important to kind of monitor what's happening with that situation. Also, important to keep in mind here, your typical relationship, when you're thinking about refinery runs and oil prices, is kind of being thrown off here. Because if Russia does not have refinery infrastructure in which to run its oil, you can expect that to actually be bullish for oil prices. Why does that make any sense, right? If they're running less, why they would just export more oil, right? The reality is they can't do that right now because of sanctions. They are maxing out on the oil export side how much they can sell into the international market. And this is going to places like India and China. But India and China can't take much more Russian oil. So let's say that Russian refinery runs really get hit hard. And this actually pushes Russia to have to decrease oil production domestically, okay? So actually that is a bullish factor for oil prices if we see more Russian refinery infrastructure come offline. Traditionally, that would not be a bullish factor, right? Traditionally, if we weren't in the sanctions environment and Russian refineries, for some reason, weren't able to operate, Russia would just export more of that oil into the market. But that's not the situation we're in now because they have a limited set of downstream markets in which they can sell into. But again, specifically when it comes to the diesel market, yes, some production has been knocked offline. Don't think it's going to have a big impact on the material balance globally. Like I said, though, where is the inflationary pressure when it comes to gas, oil, and diesel markets? It is focused on Europe. So I want to just direct your attention to this right-hand chart first. Again, let's go back to our core supply-demand balance I've been talking about here. Europe faces a material net shortage in diesel of about 1 million barrels per day. In other words, the amount of domestic supply relative to the level of domestic demand is about 1 million barrels short, which implies that they need to import that volume from abroad. Why is this happening? It's not really a demand story, it's a supply story. And there's two reasons why European diesel production domestically is declining. One, outright refinery runs have just fallen quite a bit over the last 10 years due to environmental regulation, but also COVID demand destruction. But the second key factor is that European refineries are being forced to take lighter, sweeter crude versus heavier, denser crude. Light, sweet crude tends to produce more gasoline and less diesel. Lighter, sweeter crude tends to produce more gasoline. Why? Because Europe is no longer importing heavy, dense Russian oil. They're importing more light, sweet US oil. And this is having a material impact actually on their diesel balance domestically. So let's focus on the market now. If you look at just spot ICE gas oil diesel prices, we got this big surge higher in prices in February. And you'll notice that the net long interest, so this is basically just the number of people who are holding futures contracts long, less those who are holding futures contracts short. That net long has increased a lot, which shows that there is bullish interest in ICE gas oil and diesel, the ICE gas oil diesel contract. And again, we saw this surge in prices, not only outright, but also that diesel margin as well that refiners could receive through February. This is significant, right? If this continues, that could have an inflationary impact. Well, why is this happening? Let's look at, specifically look at Indian seaborne diesel exports. They fell off a cliff in January. Anyone have an idea why this is? Think about where India is located relative to Europe and certain situations going on. Yes, go. Yeah.
Suez.
Exactly right. You had this response to the Suez issues and the issues in the Red Sea, where India said, we're not shipping volume into Europe right now, right? We're going to cut volumes. We'll keep it in Asia. We're not taking the risk. And on the other end, European purchasers even were like, we don't want to take the risk right now. This is significant, right? Because this shows, again, if we go back to this chart, this shows a lot of vulnerability in Europe right now when it comes to diesel availability. If you have some other geopolitical event, maybe an escalation in the Red Sea, maybe something else, that could push up prices again because they're importing a lot of volume, not only from India, but from the Middle East in general. India is just a good swing producer to kind of to show as an example here. Of course, when you're looking at inflation levels, this is just EU27 HITP inflation, harmonized indexes. You'll look, energy has a clear relationship to headline. And also they did start, several years ago publishing diesel inflation statistics as well, right? When you have a lot of energy inflation, you have a lot of headline inflation, right? And that's a problem. So the reason I bring this up is that it's not necessarily, maybe the Red Sea stuff in the Red Sea does not continue. Okay, that's fine. But Europe is at risk because of just how much diesel it now needs to import from abroad, and it's going to have to pull a lot of those volumes from the Middle East. Yes, it can pull some from the United States, but there are risks certainly at play in the market right now. That could be quite inflationary. Okay, let's shift to the gasoline side of things now. Now I'm going to focus on the U.S. because the U.S. is definitely the gasoline capital of the world. But let's level set. Let's look at the global market first. You'll notice actually gasoline markets are pretty tight this year, right? 50 KBD in terms of supply outpacing demand, not a lot. Why is this? The growth in demand is going to outpace supply for the second year in a row, right? So this net gasoline balance is narrowing quite a bit. If we kind of focus on the United States, my expectation for, say, retail U.S. unleaded prices this driving season, which is really the critical period between May and August, I think could trade up to, say, $3.75 or $3.80 per gallon. That is a roughly 4 to 5% increase relative to the same period last year. Okay, that's inflationary. A 4 to 5% inflation rate on gasoline is significant, right? Why do I believe this to be true? Two reasons. One, again, our expectation of higher oil prices from here also lifts gasoline prices, but also the material balance in the United States. If you look at the monthly balance for gasoline, again, a negative bar means demand is outpacing supply. That balance is worse in every month for the summer driving season this year. So important to keep in mind that there is some risks there. Just looking at the market again, right? We've seen a lot of bullish interest again in futures markets. Net longs are definitely towards the 52-week highs in terms of that range that we look at there. And then if you look at the chart on the right, again, we're trading under 350 right now. I think, again, we'll probably put the 375 or 380 by May or June. And I love to put this up against the orange line, which is you look at YouGov polling just about how consumers feel about the economy. There's a clear relationship. When prices rise, people feel worse off. And this is significant because we're going into an election year. And if gasoline prices really accelerate higher, that will get injected into the political conversation. You can bet on it for sure. All right. Just a couple more points here. When you're thinking about, okay, well, how important is gasoline to the consumer? It has declined a lot, right? In the early 80s, in the early 80s, consumers were spending north of 7% of the total consumption basket on gasoline. It's declined a lot. However, we did see a spike in 22. You had, following the war in Ukraine, you saw this huge spike in oil prices that pushed up gasoline. Consumers were spending about 4% of their consumption basket on gasoline. Last year was about 3%. I think we'll push back to around 3% again this year. That's towards the upper end, like, say, the last 10-year range, if we exclude that 2022 outlier. And again, just, looking at how headline inflation is impacted by energy, it's definitely there. Gasoline definitely plays a role in that. One last key that I want to highlight, because I know I'm running out of time. I want to talk about China. Right now we're very focused on, and what are the economics and how is all of this playing through to prices? It is really important to understand that China has become a key swing producer for gasoline, for diesel, for jet. We've seen this massive refinery expansion in China, and yet they don't need all of that production, right? If you look at this right-hand chart, they're producing almost 900 kBD more than they need domestically when it comes to diesel, jet, and gasoline. That can technically be volume that is exported, but it is very important to understand China does not fundamentally operate under a traditional economic model. They, especially when it comes to petroleum markets, they are concerned around supply security, okay? And so when we're thinking about China as a swing producer moving forward, when prices rise for diesel, we cannot just fundamentally assume, okay, China's going to export more volume. That might or might not happen, depending on how the Chinese government feels about domestic stock levels. Last year was a perfect example. There was a good opportunity late last year to push extra diesel onto the market, but they did not. And just one key here, this black line basically is quota utilization. So the Chinese government will basically issue quota to refiners that they can use to export, but it's limited. So that's what this quota utilization number is. And so you'll notice in late 23, that quota utilization pushed almost to 100%. And refiners had to cut, say, exports of diesel, even though the market needed diesel. The reason being the Chinese were worried about domestic inventory availability. So again, I bring this up to kind of highlight, look, the way China operates is quite different from the West, and yet China will be a very critical piece of this global petroleum product market moving forward. All right, that's all I got, guys. Questions?
Thank you. And as an economist, I really appreciate how you framed everything in terms of supply and demand. I hope all the undergraduates, take the lesson to heart. You talked about China towards the very end, but more from a supply perspective. As far as China, from a demand perspective, as we've talked a little bit about how China's economy is slowing down. Do you guys view that as a risk factor for demand side on the oil markets or in general?
Absolutely. China for the last 20 years has been the consistent growth driver for oil demand. That is slowly disappearing. However, it's important that we kind of level set post-COVID recovery versus longer term output. Last year, people really underrepresented or maybe didn't fully understand. Like Chinese demand growth was huge. Core product demand was 900 KBD. Okay. Economy didn't do great last year, but people were still flying a lot, arriving a lot, getting out again. This year, we see demand growth at around 300 KBD across core products in China. But I think that like demand factor will start to flatten out moving forward. They're not going to be the consistent growth driver that we saw the last 20 years. It's just not there. Places like India are probably going to replace them, but India, keep in mind, India is a much smaller economy, so it'll take a long time to get, to the levels of demand growth we saw in China.
Okay. So, just a quick question, and I know most of your focus was short term, as you said at the outset, but do you think at all about the switch to electric vehicles and then how that, it looked like it was going to be higher, and then it seems like consumers are now turning away from that and so forth. I mean, does that factor into the analyses that you do?
Absolutely. And it's in region will play a big role. I think European EV will be pickup will be far faster than the United States. Just a couple of statistics, like EV offsets to gasoline demand in the US is probably not even 100 KBD. And we consume over 9 million barrels per day in the driving season, right? So EVs are a very inconsequential piece of the demand offset right now. When I'm thinking of EVs, can I actually give you a good number of where this is going? No, I can't. But I think in the US, expect that demand offset from EVs to gasoline and diesel to be a lot slower than in a place like Europe or China. China as well, I think EV pickup is going to be really large. But again, China is coming from a place of supply security because they have to import 10 or 11 million barrels per day, right? So they have an incentive to really pick up EV, EV output moving forward. And that's another key point is if you're a big net producer like the United States, you're not maybe necessarily as worried as a place like Europe or China, which have to import a lot of crude, right? And so that's a geopolitical risk. So EVs are a good offset. And it maybe doesn't have to be fully economic for them.
Can you talk about the Strategic Petroleum Reserve here in the U.S., which seems to be still rather empty?
Yeah. So it's been interesting. Biden obviously has drawn on the SPR heavily. It did tend to work, actually. He did it helped to limit the appreciation on the oil prices. There are kind of two competing camps in Washington right now when I'm in DC talking to policymakers. On the one hand, you have folks who say, we're producing tons of oil. Why do we need this anymore? That's mostly Democrats who would like to draw it down further. And then mostly on the Republican side, you have a group of folks right now who would like to see it rebuilt. I'll tell you right now, I don't think it's out of the question that if we get oil prices really oil and gasoline prices really accelerating this summer, that Biden looks to draw on the SPR again ahead of the election. I think there's a possibility he does it again. Will he there have been like a little bit of conversation about refilling, but I don't think this administration is going to do that. Go for it.
We speak to the reality of NASDAQ. You got well, a lot of work.
It's absolutely there. You look at U.S. gasoline consumption, we'll never get back to 2019 levels. We're flatlining right now. And I think that moving forward, we can expect gasoline demand in the United States to consistently decline year over year moving forward. Part of that's definitely work from home. And it's been interesting. We had a structural break in demand through COVID, and we have not managed to get back to that 2019 level. I don't think it will ever happen. Same situation in Europe as well. Your developing markets are a little different, just because they maybe have less access to work from home tech. But I think especially when you look at the US and Europe, the era of pre-COVID demand is done. And we're moving in a different direction, especially when it comes to the core clean products. Jet may be the one outlier to that, but your big diesel and gasoline markets are changing for sure.
Like to, just push back a little bit on the overall story that we saw today. You all seem to think there are the risk factors for causes for, structural inflation. But just 2 days ago, we had, Jerome Powell talk about what the Fed's outlook is, right? So right now, unemployment rate is below 4%. Inflation is below 3%. Core PCE. If you look at long-run inflation expectations of households, you choose your favorite survey. It seems it's the long-run inflation expectations are also below 3%. If you look at the 10-year T-bill rate, they're not that much higher than pre-pandemic levels, which would also suggest that markets expect interest rates to come down and inflation to come back to potentially 2%. Things seem pretty good. Things seem like we are going in the right direction. I understand, there are lots of structural issues that, in the labor markets, there might be segmentation. You might be talking about high skill versus low skill, or certain markets are doing better than others. So, what would you say to someone who is so, who might be optimistic about where we are and the numbers look great?
That's right. I guess maybe three things. I thought it was noteworthy on Wednesday that the Fed actually raised their inflation forecast. Not a lot, just a little. Even, and actually 5 of the 19 people that submit their economic forecast each quarter actually raise their Fed funds rate expectations. If you looked at the mean instead of the median, their guess at year-end 24 actually went up 10 basis points. So I think, we're talking tiny, right? But I think the second point, if you look at the progression of, say, 3-month inflation, it's moving higher. It's whereas in the last 6 months of 2023, it was consistently moving lower. I think the third point I'd make, and the one I didn't touch on because I think it really is, maybe it is, maybe it isn't, but if you look at durable goods pricing over a very long period of time, until China was allowed into the World Trade Organization, the normal trend in durable goods prices has been up. And, when we look at the, say, roughly 15 to 20 years of about 2% inflation that we experienced, we got there by services rising about 3% and durable goods or goods declining by about 1%. So I think there's some very open questions about what is durable goods pricing going to look like. In almost every category. It makes sense that there's near-term softness. Again, the chart I showed of we all went to Home Depot, we all bought, new stuff when we couldn't go out. And so there's softness there as we've sort of maybe gone a little overboard to how many bars and restaurants we're going to these days. So I guess to put it all together, and maybe actually let me add a fourth. I think inflation could be much lower short term if we see unemployment go sharply higher, which could it? I guess so. It's easy to watch. We get new data every Thursday morning at 8:30, well, East Coast time, 7:30 here, on weekly jobless claims. They're at almost record lows. So the labor market is very tight. And I think that's why we're seeing average hourly earnings like 4.5. We're seeing median wages 5. With that kind of wage growth, it seems to me a gentle sort of what's in the Fed's forecast. As I said, and I'm not totally comfortable saying it, I think the Federal Reserve is in highly political mode right now. It's sort of the same way if gasoline prices go up, sure, we'll empty SPR if that's what it takes to try to keep inflation down until November. So I try to speak with conviction that, there's only one way this thing can go is up. But I think for me, the real way inflation surprises to the downside is if there's a pretty violent deterioration in the labor market.
I have to defend the Fed there. To say the Fed is political is heresy. What the Fed is trying to do is trying to get out of the way of anything, just so they can just have not make any decisions, so they don't influence the election one way or another. And by the way, you just find all of us as pessimistic. I don't think that was the case. We had one pessimist, and we had 3 of us who were. It's just going to be different. So don't put us all in the same basket.
The Fed meeting was yesterday or a couple days ago. Confused me. You have the Fed basically revising higher growth, revising higher inflation expectations, revising down unemployment, and yet they're sticking to kind of their cut schedule. That's confusing. And then Powell talks about, not super worried about relatively hot inflation statistics through January and February. He said it was a bump in the road. That is confusing to me, especially if you look at just month-over-month inflation that's smoothed over a 3-month moving average basis. Inflation bottomed like late last summer, and we're trending up again. To your point, my view is if the Fed doesn't start cutting in June, we won't see a rate cut this year, because if they wait till the next meeting, they're between the 2 national party conferences, which they don't want to get injected into that. And then if they wait to the next meeting, they're a month out from the election. So I think that's, folks on the Fed want to cut rates, but the data's not really aligning with allowing them to be able to do that right now.
So for the 3 of you, the last year and a half have been the worst period for economic predictions in my career. And this is reinforcing the new era stuff. So for those of you who don't follow this, the most extreme example is in the 3rd quarter of last year, consensus for growth in the 3rd quarter, just the next 90 days, was 50 basis points. It turned out to be 5%. What is going on with traditional economics that is causing, and I follow like 13 really good ones, and it's all of them are missing the mark by quite a bit. There's always a tinkering around, but